What we can do is set up a screen, and the screen is just going to look for companies that are in that discount range. We can also add in other things there, which I would recommend, right? So you can add in, for example, I want the company to be undervalued. I want like not too much risk. That's typically a company when it's undervalued, it's typically riskier. That's always the investor's dilemma. So you can say, well, I want some risk. I want only a maximum amount of risk. Now remember, our risk analysis at Simply Wall Street is again looking at the fundamentals and the fundamental risks, not necessarily the qualitative risks, which we'll talk about in a bit and how we handle that. So this is such an easy place to start. We set the screen up, and there'll be a lot of companies, almost be too many. So then I would recommend further refining it to something that suits your taste. Ideas could be balance sheet health, that could be one angle. Another one could be you want growth. Now remember, you don't need growth for the company to be undervalued. It's classic value investing. Actually, sometimes the companies might not be growing. A company can be high growth, it can be undervalued, it can be low growth, it can be undervalued. This idea of value and growth, it's really all the same thing. So we set up our screener, we save our screen, and once you save your screen, if you're on a paid plan, what's great is we're going to check every week if new companies match. So you don't really have to do anything. You just have to wait, and we'll email you when we find new companies that match that screen. And don't blindly buy them. That's not the idea. The idea is that these are interesting companies, and these are companies, this is an angle that a lot of investors are not looking at. So this is how you're often going to find companies that are not in the media, in the news, in whatever newsletter. And well, that's awesome. That's super exciting. And then we can dive in and see if it's interesting.